The domestic economy ends the year with low unemployment and resilient economic growth, but similar headwinds to the rest of the world. Our thoughts on the outlook for 2023 for interest rates, jobs, and the financial markets. The latest GDP data showed economic growth of 5.9% over the last year to September 30th, a stellar recovery from the Delta lockdowns just over a year ago, but marking the top of the economic cycle before the full force of the RBA rate hikes start to weigh on the economy. GDP growth for the quarter was 0.6%, down from 0.9% in the June quarter, and from here, the accumulation of 3% of rate hikes since May will hit demand and household spending, especially early in the new year. As a result, the annual growth rate will quickly decelerate to between 1 and 2%. But fortunately, we enter this slowdown with labour markets in excellent shape. The unemployment rate is down at 3.4%, its lowest level in 50 years. And other indicators, such as underemployment and hours worked, all point to very strong but tight labour markets. So, the economy is better positioned to deal with the slowdown than any time since the GFC. However, with another RBA rate hike likely in February, taking the cash rate to 3.35%, this will start to take the momentum out of the jobs market and likely push the unemployment rate back above 4% by the end of 2023. Rate hikes impact the economy with a lag, but the inflated cost of all goods and services is already hitting household budgets, and high inflation means real incomes are falling and asset values being eroded. The solution to achieving sustainable real wages growth lies in reducing inflation back to its target, which should make steady progress next year, but also demands lifting labour productivity, something that's been elusive for decades. So, the Productivity Commission's recommendations, to be released in February, will be vital to guide government policy and further structural reform. The wage price index is back above 3%, its highest level in a decade, and 2023 should see it rise further to around 3.5%. But getting inflation back down to below this level will take time. The RBA have utilised monetary policy with force, and next year have 1 to 2 more hikes likely to be deployed. But assuming they stop hiking the cash rate in the mid to low threes, they can still achieve their desired soft landing, in contrast to many other larger economies around the world who we still expect to fall into recession. The financial markets remain volatile, weighing up these relativities and trying to get a handle on whether inflation has peaked and how quickly it might normalise. Many other central banks are taking official rates to around 5%, making a soft landing much less likely. So in 2023, the key variables will be how quickly inflation starts to fall, how interest rate sensitive various parts of the economy prove to be, and supply factors and related policy settings, for example, China's COVID-0 policy. The Australian dollar is a good proxy for risk appetite in Asia Pacific, so its recovery from just below 62 to 68.5 US cents is encouraging locally. And while this primarily related to the US dollar losing some of its recent strength, policy settings in China were also a contributing factor. In 2023, while we still expect a mild appreciation for the Aussie, volatility across the markets will remain elevated. And so, Australia staying out of recession may more reliably translate to further gains on a trade-weighted basis than against the volatile US dollar. And lastly, property values remain on the defensive, with the peak-to-trough fall now 7% nationally, around half the likely decline. But one of the consistent aspects of 2022 has been just how uneven these price movements have been, by state, region, and by attribute. So, 2023 will see further falls, but still with clear examples of outperformance and resilience. And that's the market update from Bendigo Bank, with best wishes for the holiday season.